Hey champ, today we're going to be talking about time horizons. So this is different to time frames. As we can see over here, the chart that we're looking at right now is a 5-minute time frame. This is different to what we're going to be talking about, which is time horizons, but the two are very, very closely linked. The problem is I see most traders focusing on the time frame, this thing up here, and not focusing on time horizons. And this is the cause of plenty of problems that I see traders having, a lot of obstacles that they face and they don't know how to overcome. Things like exiting their trades too soon, not having enough profit, exiting their trades at too big a loss, not knowing where to put their stop loss, not knowing where their TMP is, all of that kind of thing. And what it's leading to is having a mismatch between your entries, what you're basing your entries on, and where you're exiting your trades. Now, hopefully from the last few lessons that we've been doing with the whiteboards, those type of lessons, you're starting to realize, and from me keeping on saying it, that the Duomo method is based on one underlying theory and everything is built on top of that, which means that everything you learn about is interconnected and interdependent. So imagine a situation where you're going to a job interview and you're wearing a nice suit. So you've got your black trousers on for your black suit, you've maybe got a nice red tie, white shirt. But then if you put like the suit jacket from your grey suit with the black suit that you're wearing, and let's say that is tweed instead of the, I don't know, polyester, I don't know what suits are made out of, it's not going to go. Suddenly you've got everything matching up until you've put this jacket on, and as a result of that, it's ruined the entire thing. So let's say that you went to the interview and they liked your answers and everything, but they said that your appearance was not good enough. Then you'd be making a judgment about the entire thing saying that the appearance wasn't good enough, when if you broke it down to the components, you'd see that actually 90% of it was fine, but it's that last 10% that's ruining the entire outfit. And that's what we see with the markets as well. So we've spoken about the market structure. Let's take, for example, if we're doing the medium term waves here, these are the waves that we'd be looking at, down to there. So these are like the medium term ones. At the same time as those, we have some smaller waves going on that you can see in between. Like those are still the waves in the market, but at the same time you have some smaller movements that happen, like the ones down to here, right? You can see these, quite obvious, quite straightforward. And by the way, I haven't picked out any chart in particular here. This is just Aussie dollar to US dollar 5-minute chart. You can see from the movements of this green line that the market's in play right now. So it's the current live chart here. And at the same time as these smaller levels, the medium term, you also have like a sort of bigger wave that's coming along here and it's potentially bottoming out there before it comes back up, potentially, right? So putting these in perspective, I'd say that on this 5-minute chart, the black waves that we see here are sort of the main structure. So when I'm saying that I'm looking for structure in a market, I'm looking for movements like the black lines that we see here. And the blue levels that you're seeing going on, they don't matter so much because for those ones, if you drop down a time frame, so in this case we're looking at a 5-minute chart, if you drop down to a 1-minute chart, which I wouldn't advise, then these what are blue lines here might end up looking more like the black lines on this chart. And likewise for this pink level where we've got this big movement happening here, when you look at the 15-minute chart, that might just be one of the waves. So it's all relative, but basically there's this structure in the market that we're looking at. And what you want to do with everything that you're doing with your trading, you want to marry all of the parts of your system together to make it sort of very congruent, like everything fits. So for example, when we're looking at the time frame that we're trading, there were some questions that we ask ourselves, and we asked them at the start of the mini series that you get for free for signing up for our Inner Circle. The link's in the description box if you haven't seen that already. And we start off our full course with it, our full online course, where it's going to be 12 to 15 hours and you put together all the different components that suit your style, but it all starts from those questions at the start. What sort of trader am I? Or like, what sort of person am I? What are my strengths and weaknesses? Am I a patient person? Am I good at maths? Do I work well under pressure? Do I prefer some time to think over my decisions? Am I a rash decision maker? All of these kind of things, as well as how many hours per day can I commit to trading consistently? And from these things, you figure out what time frame is best for you, because that's in terms of your personality, and also based on the amount of time you can trade, what your time horizon is. So that's what we're getting at here. So for example, let's say that you can trade, and let me switch back to black here. Let's say that you can trade for 5 hours each day. right? That's a decent amount of time to be trading. It's not quite full-time, but it's between full-time and part-time there. Well, it is part-time, I mean, to put it bluntly. If you've got 5 hours to trade per day, there are different options available to you. You could trade a 5-minute chart. You could trade a 15-minute chart. You could trade a 1 hour chart, 4 hours. You could trade even a daily chart, right? I should put 1 day, otherwise I'm just writing D on my chart and that's not a good thing. So you could trade all of these different time frames. But more importantly is what those time frames are going to mean for you. For example, for the 5 minutes, you could be trading, looking for trades that's going to be for the entire session. Or you could be looking for ones that are maybe like a quarter of the session. For 15 minutes, same thing. For 1 hour, you could be looking at ones that end at the end of the session. Or you could be looking at ones that last multiple sessions. So where you're maybe having them for the rest of the week. Same with 4 hours. Are you looking for that 1 4-hour trade when you're going to open it? That you open and close in that session is going to last longer. The daily is looking for trades that are going to be for the next day, for the rest of the week, for weeks, for months. What is it? So the time horizon matters. And the reason it matters so much is because everything we do with our analysis is going to come from that. Everything we do with the structure of the market and so on. But here's the thing that I keep seeing people do. So let's take, for example, let's say that for whatever reason with the significant levels that we got, we identify that this point here is an entry to go short. So we're going short at that point in time. Now, we might have identified that based on the structure that we drew, the black waves that are going on here, and that was the top of the wave, we identified it, and so we're expecting it to keep going down. Now, what might happen in this situation, and what I see a lot of people doing, is like they're fine in this part here, where it's mainly the bearish candles happening, but suddenly, at this point here where there's a bit of fluctuation, they start justifying to themselves why that should be an exit. So the usual case that you can't see here is that maybe, like, let's clear these off the chart again. So maybe you'll hit a low here, and although this one's broken through, but let's say that it ended up here and then came back up, they'll say, oh no, I'm getting higher lows now, and therefore I need to exit the trade. So they're saying that the trade's come down here, now they're getting higher lows and they need to exit. Now here is the problem. They've entered the trade based on these broader movements. And with those broader movements, that means that you're looking at these waves as the structure in the market. Remember when we talked about the structure? So you've got the 3 reasons to exit or enter the trade. You've got 1 is the structure. Well, actually 1 was the setup, but we'll put that in as number 2 is setup. And number 3 was path of resistance, or you want to go down the path of least resistance, but path of res, and there's some other factors, but those are the broad ones that we look at in the Duomo method. Everything's based around those. And in this situation, if you're looking at the structure purely, and let's say that that's ended up there and you're exiting, you're now actually exiting your trade based on the smaller movements that happen in between the waves. The problem with this is that look what happens. That smaller wave, yes, okay, maybe you're in a sideways market for 2 waves there, but it comes back down, and even coming up to here, like you start maybe seeing these where these smaller waves are getting higher highs and higher lows, and someone might say, I'd better get out of this now because we're getting higher highs and higher lows. But the thing is, when you're looking at the structure of the market, the waves that you should have been looking at in your time horizon, which are these ones, then you're still getting a lower high there, and you still had lower lows, and look what happens, the market's come back down again, it's gone even further. So what's happening is people are getting nervous and they're looking at the wrong structure of the market. So this is where I'm saying you need to understand your time horizon. This is also where we look at our stop losses and things like that. For example, let's say that you enter a trade here, then I see people that are in, like, basing their stop losses on, like, let's say this point here or something, and saying, you know, or like here, saying, no, I'm going to look at the previous waves. But the thing is, if you've based it on these waves coming along here, you need to at least be waiting for that point for it to get a higher high. If that was the previous high, you need to get higher than that point. Same for your exits then. So if that's the point that you're trying to break through, and it doesn't quite do it there, but then it does it, then suddenly you're getting lower lows, so you want to stay in the trade. Up here, it doesn't break above there, it's not a higher height, so you can stay in the trade again. Like, it seems like a really straightforward thing, but this is where I think a lot of people are going wrong. So the people that say that they exit their trades too early is because they're looking at the broader movements in the market, but then they're like, say they enter short here, they're looking at this part where suddenly they get a one candle reversal and they say, oh, the market's changing, and they exit. But they might have based all their like expectations on the broader movement. Suddenly one candle is mattering. Like, for everyone, I think when you first start learning to trade, there's always this temptation that as soon as you get one candle going against you, then you start to panic and start thinking, oh, maybe I'll exit now. But let's take a look at what over here was quite a nice strong downtrend. If you got a trade over here or doing good, like, how many times do you actually see like bearish candles in a row for like 5 candles or something? I don't think there's even a single time here. You get a lot of times where you get a couple of candles against you. You've got to let the smaller waves play out in order for the bigger waves to take place as well. So this is the thing, like, you need to start to understand what you're actually trading here. And this is another point, is that, for example, these ones here, like these waves that are going along here, if these are 5-minute candles, and let's say, look, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So from that point to, what was it, that point, that's an hour. So let's say that it's going to take 3 or 4 hours for a wave to complete. And you're entering your trade like here, and you're wanting for it to go upwards, and you're waiting for the wave to happen. You're potentially going to be waiting in this current market for a few hours for a wave to complete. So you might be in a losing trade for a little while and still be correcting the structure for like a few hours before it comes good. It's all about understanding what the market is showing you, what market you're actually trading. People enter a trade where they've been looking at previous waves taking a long time, and they might get the initial sort of reaction that's good, like the first sort of smaller wave going in their favor. Then it might go against them a while or go sideways, and they start panicking or wondering what's going on and exit their trade. And you know, like in the future, then the market might end up shooting higher and going really, really high in the favor that they, like, in the direction they thought it was going to be going in, and it would have been in their favor. And they say, oh, why did I exit too early? It's because you're not realizing that the waves that have happened before are, you know, on a different scale to what you're basing your exit on. So, like I said, this is going to be a basic sort of high-level discussion around it, and I don't want to go into too much detail, the specifics now, because we'll end up having a very long video that you won't digest properly. I just want this to be in your minds that you need to marry your time horizon with your time frame and how you're exiting your trades, where you're basing your stop losses and everything, which structure of the market you're looking at. And if your time horizon is not matching what you're looking at that point in time, like let's say you're basing your entry on these sort of waves that are happening along here, then you only want to be in a trade for a short amount of time. So if it's not happening straight away, you don't want to be in it. Whereas these bigger ones that are happening is a completely different story. So make sure whatever you're basing your trades on is correct for you. And if you're looking at the sort of the longer term, then maybe you need to change your time frame, or maybe you need to drop your time frame. It just depends on what's going to bring together that time horizon with your time frame and with everything else you're looking at. So guys, I imagine there's going to be some questions from this one. So if you do have any questions or comments, leave them below and I'll try and answer everyone. We are going to cover this topic again. I think it's a really interesting one. It's actually one of my favorite topics. Like, this whole structure of the market thing is one of my favorite things because it really clearly shows what's going on behind the scenes of the market. Let's not forget that markets, we can't predict. Like, we don't know every single candle what's going to happen, but as a whole, the markets are what we call phenomenological, which means that you can't tell from the individual components what's going to happen, but as a whole, the market shows certain characteristics that we can identify and we can predict. And this wave structure is one very clear way of doing that, and it's one that allows you to stay in trades long enough. Like, for example, if you're entering here, then you don't need to exit based on a structure until that's broken, which is all the way over here. You could have stayed in it all this time. Whereas if you get confused, start looking at smaller waves, you're getting lost. And this is what I want you to figure out. So sorry, I was actually wrapping up the video then I got carried away again. So if you like this video, leave a like, subscribe for more videos about learning to trade, and we will get stuck into this topic again very soon. Thanks for watching, guys. Take care. I'll see you soon.